And then lastly, account management. Account management starts with the first discussion that an investor has with their broker. In our company, we use something called the Futures Trading Plan Questionnaire. And in this questionnaire, there are 30 questions that we go through in order to determine what markets are good for this investor and only find those markets that match his risk and reward ratios properly and get him to invest in those things that fit on his plan. The second thing we use are trade worksheets. And these trades show the entry, the exit, how much margin will be. And since every futures contract is different as far as value, it also shows what each increment of value will be. So for instance, with the gold, $1 move in gold represents $100, whereas in coffee, a $1 move may only equal a 1 point move may only equal $16.25. And it's good to know these things and as part of account management. And then lastly, what we discussed earlier, the trading journal, which is kept by both the broker and the investor. The fifth is misunderstanding the differences of day trading, swing trading, and long-term trading for futures. Day trading in futures is highly discouraged by me. I don't believe that futures need to be day traded because the leverage is so much that a 10-cent move is more than profitable for you. So it's not necessary to trade in the minutia. Second, swing trading is really typically where we spend most of our time. Investments in 7 to 10 days holding a contract is very typical in our company, anywhere maybe as far as 2 to 3 weeks. But the reality is there is no real long-term trading in futures. You can't hold a futures contract forever because each contract expires on a different timetable. And since they expire, there's no way for you to know in the next contract if the trend will continue. If you're up in one contract, close the contract out. So it's a little bit different dynamics when it comes to futures trading. And you have to attribute or apply some of the things you do know from your stock trading and your stock investing and kind of shorten the time frames that you have for futures trading. Now, part of the reason why I dislike day trading is the #1 rule from the CFTC, or what I consider the #1 rule, is no churning. And churning is defined as entering and exiting trades solely to generate commissions. This is a very important concept because in futures trading, the commissions tend to be higher. You know, you rarely find a $7 or $8 round turn commission. Typically, even on the discount level, you're looking at $10, $15, $20. So entering and exiting trades rapidly can really affect how much your profits are going to be at the end of the day. And basically, many people find themselves actually churning their own accounts. When they trade for themselves and don't understand futures, fear gets them in the market, greed gets them back in, and it's a constant cycle that just ends up generating commissions for the brokerage house and not profits. And there are unscrupulous brokers that are out there that you do have to be careful of, who will try and get you to trade constantly. Like I said, we're position traders at our company, and so our focus is not on the trading specifically, but on the traders and what the goals of the traders are in the trading journals. So be careful, don't churn your account. 6, trading without a plan. This is indicative of many traders in all spectrums, whether they be option traders, forex traders, stock traders, futures traders. Many traders have one goal in mind. They want to make a lot of money. Unfortunately, this kind of goal doesn't allow for the potential that there will be losses. And so you have to modify your goal and put it into a trading plan. Trading without a trading plan is like operating without a roadmap. You end up running around in circles. And this is very typical of many futures and commodities traders. They will invest in futures based on either some hype from a broker who calls them up or some fundamental information they'll read in the newspaper, such as beans are going in the teens, or heating oil, you know, it's winter and now heating oil is going to go up. And they'll take a hunch, really won't research the trade, they'll throw a lot of money at it with no plan as to how they're going to get out if the trade doesn't work, with no idea of why they're trading this investment in the first place beyond this hunch, and they end up hurting themselves. And 4 or 5 years later down the road, after they swore off commodities altogether, they try it again, doing the exact same thing. And as I've heard it, insanity is doing the same thing over and over again, expecting different results. So you have to approach futures with a trading plan. It helps you assess your risk tolerance. It also helps you develop goals and get you out of the lofty idea that you're going to make $200 million off of this one trade. You know, the futures market is a unique industry because of leverage. So if stocks are doing 12%, they say aggregate over time, or 7%, you know, the range is 7 to 12% in the stock market, all you're hoping to do is do a little bit better than that. If you can do 20 to 25%, you've won with futures. And so having a plan and shooting for specific target goals are very important. And it's an easy way to navigate between the demons of fear and greed, because fear will hold you back in your trading, and greed will get you in at the wrong times, and you always find yourself buying tops and selling bottoms. So trade with a plan. I just cannot emphasize it enough. 7, not keeping records of your trading. Now, I don't mean your statements. Everyone receives investment statements showing how much they lost and how much they made. This is different. By keeping a record of your trading, you're actually showing yourself what you're doing from beginning to end to either improve your success or diminish your success with losses. And the best way to do that is to keep notes on every trade you take. That means that when you enter a trade, it's a planned trade. You know your exit strategy ahead of time, and the exit strategy can be both sides. You know when you're getting out on the upside, you know when you're getting out on the downside. You know your entry strategies, you know how much you're willing to lose on this trade, and you also have the setup of the technical analysis tools or even recommendations from newsletters or brokers that convince you to take this trade. Make sure that you keep accurate records of these things, and also keep records of when the trade works out or doesn't work out. And you can see over time what your percentages are and how well you're trading. Keeping records is essential to your investment experience. 8, looking for trading confirmations. Once again, this is a problem with anybody who invests. You'll always have people who are for a market and people who are against the market. And if you allow that type of influence to come into your day-to-day trading, you'll end up not being successful in your decision-making process, because there's no way that you'll be able to focus on the decision that you came up with if you're constantly bringing in outside information. In futures trading, Market Vane puts out something called the Market Sentiment Index. And this is an index which is comprised of all of the newsletter writers in our industry who put out advisory alerts and advisory reports that people pay for. And it calculates what markets they feel that these guys are bearish on, and it calculates what markets these guys feel that they're bearish on. And it's rather unique. As the market sentiment increases from 80 to 100%, we slowly begin to see the actual commodities themselves peaking out. And even after the market starts to fall, these guys are still promoting investing in some of these contracts. It's very similar to what happened with the recent stock market problem with the dot-com bubble. All the analysts were continually telling everyone to buy while the markets were diving down. So it's funny how market sentiment can actually hurt you and not help you. And this goes for listening to gurus and advisory reports, or even just jumping in on a whim. Just make your own decisions on your trading. You can get in advice, but at the end of the day, own your trade. Don't allow your trade to be dictated by someone else. It's important, because then you'll have a peace of mind and you'll enjoy futures trading for a long time. 9, options are not the only leveraged investment. Now, this is a point that many people like to argue with me on.